Audio Renaissance presents The Little Book of Common Sense Investing, the only way to guarantee your fair share of stock market returns, by John C. Bogle. Read for you by Thom Pinto. Dedication. Dedicated to Paul A. Samuelson, Professor of Economics at Massachusetts Institute of Technology, Nobel Laureate, Investment Sage. In 1948, his classic textbook introduced me to economics as a student at Princeton University. In 1974, his writings reignited my interest in market indexing as an investment strategy. In 1976, his Newsweek column applauded my creation of the world's first index mutual fund. In 1993, he wrote the foreword to my first book, and in 1999, he provided a powerful endorsement for my second. Now in his 92nd year, he remains my mentor, my inspiration, my shining light. Introduction. Don't allow a winner's game to become a loser's game. Let's start from the beginning. What is an index fund? It is simply a basket, portfolio, that holds many eggs, stocks, designed to mimic the overall performance of any financial market or market sector. Footnote. Please keep in mind that an index may also be constructed around bonds in the bond market, or even road less traveled asset classes such as commodities or real estate. Today, if you wish, you could literally hold all of your wealth in a diversified set of index funds representing asset classes within the U.S. or the global economy. Classic index funds, by definition, basically represent the entire stock market basket, not just a few scattered eggs. Such index funds eliminate the risk of individual stocks, the risk of market sectors, and the risk of manager selection, with only stock market risk remaining, which is quite large enough, thank you. Index funds make up for their lack of excitement by their truly remarkable long-term productivity. This is much more than a book about index funds. It is a book that is determined to change the very way that you think about investing. For when you understand how our financial markets actually work, you will see that the index fund is indeed the only investment that guarantees that you will capture your fair share of the returns that American business earns. Thanks to the miracle of compounding, the accumulations of wealth over the years generated by those returns have been little short of fantastic. I'm speaking here about the classic index fund, one that is broadly diversified, holding all or almost all of its share of the $15 trillion capitalization of the U.S. stock market, operating with minimal expenses and without advisory fees, with tiny portfolio turnover, and with high tax efficiency. The index fund simply owns corporate America, buying an interest in each stock in the stock market in proportion to its market capitalization and then holding it forever. Please don't underestimate the power of compounding the generous returns earned by our businesses. Over the past century, our corporations have earned a return on their capital of 9.5% per year. Compounded at that rate over a decade, each $1 initially invested grows to $2.48. Over 2 decades, $6.14. Over 3 decades, $15.22. Over 4 decades, $37.72. And over 5 decades, $93.48. Footnote. These accumulations are measured in nominal dollars, with no adjustment for the long-term decline in their buying power, averaging about 3% a year since the 20th century began. If we use real inflation-adjusted dollars, the return drops from 9.5% to 6.5%. As a result, the accumulations of an initial investment of $1 would be $1.88, $3.52, $6.61, $12.42, and $23.31 for respective periods. The magic of compounding is little short of a miracle. Simply put, thanks to the growth, productivity, resourcefulness, and innovation of our corp.
Sample complete. Ready to continue?